I imagine that when I have a blank financial inventory, it's my blank canvas. And when I'm going through and I'm asking the questions, I'm Picasso and I'm painting a masterpiece. And now my job is to describe to them what I see, their financial future, if one of them passes away. That's my job, is to describe what I just painted.
I'm like, what's the dream of? What's the hope in? What's the doubt for? Live to no end. This is living. The life I've been given is a gift. If I'm a living, I'm a live with the death. So what's the dream of? What's the hope in? What's the doubt for? And live to no end. This is living. The life I've been given is a gift. If I'm a living, I'm a live with the death. Yeah.
Everybody to the Living Hope Agency call tonight is going to be an absolute clinic focusing on mortgage protection. I couldn't be more excited for our two special guests, Vice President Mr. Mike Curry of FFL Valiant and Vice President of FFL Gloves Off, Mr. Josh Lockhart. Two top producers, two people that have submitted, $30K plus in a week. And one of the big ways that they've done it is by finding more opportunities in the home than just simple life insurance, simple final expenses. And we'll dig into some of those different opportunities that are available. But mortgage protection is really going to be the main focus of tonight's call. And I think the main thing that we want everybody on here to understand is that mortgage protection is not some scary thing. Mortgage protection is something that anybody can do. It's an opportunity that anybody can find, whether you're in a mortgage protection appointment, whether it was an instant internet lead who wanted final expenses, you can find mortgage protection, or you're in a final expense appointment. You can find mortgage protection there too. And it's a great way to increase your premium. So we're going to talk about a lot of different subjects here tonight in regards to mortgage protection. So let's go ahead and let's get started. Let's get right into it. So mortgage protection clinic, we're going to learn how to dial new and aged mortgage protection leads. We're going to learn how to find mortgage protection opportunities in normal appointments. And we're going to learn a couple of the different closes that you can do when it comes to sitting in a mortgage protection appointment. So let's just talk about what is mortgage protection first. I think it's important to know that mortgage protection it's life insurance. Okay. It's life insurance that pays off the mortgage loan in full, a portion of the mortgage, or it leaves behind a few years worth of mortgage payments for the surviving family member. Okay. And I talked about how mortgage protection is not scary. And people go, well, why don't you just start us on mortgage protection then? There's a reason why we start agents with internet leads and final expense leads. It's to learn underwriting. It's to learn case design. Okay. What is underwriting? What is case design? If you've been through a couple of appointments, you know exactly what I'm talking about. To be able to sit down with Bob and Mary and say, hey, have you had a heart attack, stroke, cancer, figuring out what are those basic things when it comes to what they can get approved for and what they can't get approved for. Hey, can you go grab your medications out of the cabinet? Can you grab your medication list? Just so you can learn that process. And case design is sitting down and understanding, okay, final expense is very simple. All right, Bob, do you want to be buried or cremated? I want to be cremated. Okay, well, cremation costs about $5,000. I want to be buried. Well, burial costs anywhere between 10 and it can work its way up to 20, depending on how fancy you want to get. And if you want to leave some extra money behind, we can do that as well. Very, very simple case design. Okay, learning basic underwriting and basic case design. And you'll understand once you start doing this a little bit more, that mortgage protection, final expense, they're all just fancy marketing terms for life insurance. That's all it is. There's no real difference between mortgage protection, final expense, or life insurance. It's all life insurance. The only difference is the lead is looking for that specific type of life insurance, meaning it's the reason why they filled it out. So if I buy a final expense mailer, I'm paying $25 for a final expense mailer versus $11 for an instant internet lead. All that I know about the instant internet lead is that they want life insurance. It's my job to find out why they want the life insurance. I spend $25 on a final expense mailer because they've already told me why they want the life insurance. I spend $55, $65 on a brand new mortgage protection mailer because I know that they want to protect their mortgage. Okay, so it's all life insurance. And it's important to know that you can find mortgage protection opportunities in your instant internet leads. And I find them more often than I don't find them. Okay. And it's just by going through the financial inventory. So tonight we're going to dig into a couple of things. We're going to dig into different lead types. We're going to dig into phone scripts. We're going to dig into how to set up the financial inventory. And we're going to dig into the different types of mortgage protection closes. Okay. So before we do that, I just want to hear from, let's have Mike jump on here first. So Mike, obviously we got you started, back about a year ago, and your bread and butter for the most part were internet leads. So talk to me a little bit about just what that transition was like for you with, working just internet leads and then realizing that mortgage protection really wasn't a big deal and you were finding it all the time in your instant internet lead appointments anyways.
Right. So, in the instant internet leads, you start to come across people who are older in their 60s and they want something to take care of the mortgage. Like they don't call it mortgage protection, right? But that's the reason for filling out the form. And what I started to realize on the form is it's just like Jamie said, it's just like a label. So you start to learn the word tracks of equity protection and how to turn a simple appointment that you assume was going to be a final expense appointment into a mortgage protection. So at the end of the day, like Jamie said, it's just a label. So you're just applying that information and finding the need. So the coverage is just for something different.
100%. And Josh, if you could just give a little bit of your perspective. I know that we chatted on the phone here earlier today, just on, agents who think that mortgage protection is something scary. Like, what would your advice be to them?
Yeah, I mean, absolutely. My advice is like, don't stress it. It's not. I thought that though when I first started. So I mean, I definitely fell into that where it's like it's a special lead, it's a special carrier, it's this special thing off it to the side, and it's really just not. And one of the things I started asking at the top of my in-home presentation, you'd say, well, hey, what has you looking into insurance? And they might say, I just want to take care of not leave a bill. They might say something like that. But I started adding something like, well, hey, do you want to just not leave a bill? Do you want to, maybe have some debts like a mortgage or whatever else you want to take care of? Is it income replacement? I got a 6 and 4-year-old. Something happens to me. How do they pay the bills? And just that little question got them starting to thinking of like, oh yeah, I want to do this, but I also want to do that. And I just saw how easy it was to open the conversation to other things. And that led to more mortgage conversations by itself.
Awesome. Well, I appreciate you guys so much for coming on. We're going to bring you guys back on here shortly to kind of dig into what you guys are best at, which is really setting up the entire close and explaining the process of, why mortgage protection and what direction you're going to go with a specific client. But what I really want to dig into as we go ahead and get through this is just different lead types. I want people to understand that there are different types of mortgage protection leads out there. So we'll dig into each one, what they are, how they work. So buy per lead, BPL. If you guys see that acronym, BPL, buy per lead, mail drops, call-in leads, 1, 2, and 3-month-old mortgage protection leads in the CRM, and aged mortgage protection in the CRM. So these are going to be your 5 main mortgage types. Now, I can also get mortgage out of instant internet leads and final expense leads. I want to make sure that's abundantly clear. You do not have to have a mortgage protection lead to sell mortgage protection, because when you go through the financial inventory, it's all about finding the need. And a lot of the times you're sitting in a specific appointment, you go through the financial inventory. I can't tell you how many final expense appointments I sat on in the beginning where I found the need for mortgage protection and sold it. And it was just, hey, this is going to take care of, 18 months of paying your mortgage and take care of your cremation, very simple things like that. So we'll dig into these and then we'll go into some phone scripts as well. So buy per lead, really simple, brand new buy per lead. You're looking at anywhere between $50 to $80 a piece. So these are the golden leads. All leads are good. But these are leads that you're going to have a much higher pickup rate. These are the ones that are much more exclusive, the ones that you have to lock out specific counties across the country. And they're not as available in every area as we'd like them to be, but buy per lead are fantastic. This is, they send out 1,000 pieces of mail, and every single time that a piece of mail comes in, depending on the type of, depending on the specific vendor, they're going to charge you 55, 65, 85, whatever that dollar amount is per lead as they come in. You're on an actual contract with that vendor, and you have to find somebody else to take over your county if you're going to jump off of that contract. Mail drops, very simple. Rather than a buy per lead, you're buying a pack of mailers. So if they were going to send 1,000 mailers out to a county. Mid-Atlantic Marketing is a great example. They'll send 1,000 pieces of mail out to a couple of counties, and it's 69 cents a piece. Now, however many come back, that's what you own. You get as many come back. So if 10 come back, you get 10. If 100 come back, you get 100. Okay. But generally it's like a 1 to 2% return rate on mail drops. So if it's 69 cents per mailer, you're looking at about $690 per 1,000 mail drop. And rather than buy per lead where they send out 1,000 and you have to buy every lead that comes back in, you know what it costs to send out 1,000 and you get whatever comes in regardless. So buy per lead mail drops. You've got call-in leads. So this is a postcard that goes to somebody's house after they finance or refinance their home. That typically has a phone number on it for them to call in to get more information about how to pay off their home if they were to pass away. It typically has some funny code on it, like pink, purple pig or something ridiculous. And you call them and you give the script and you can give them the code to make sure they know that that's the reason why you're calling is in regards to that card. So buy per lead and mail drop. It's a physical postcard that they're filling out and sending back in. The call-in leads is a postcard that has a phone number that they're calling in to get more information. Now you've got the 1, 2, and 3 month and aged mortgage protection. They're the exact same. They're mailers, just they're older. So you've got the 1, 2, and 3 month, which are 1, 2, and 3 months old. You've got the age mortgage protection, which those can be anywhere between 1 year to I've even seen 8 years old. Okay. And you can get them for very, very cheap. So a brand new mortgage mailer, $50, $60, $80. A call-in lead, you've got call-in silvers and call-in golds. The only difference between that, I won't go too deep into it. A call-in gold went through the whole phone call, listened to all the prompts, and they made it through the entire thing and want more information. A call-in silver, they hung up at some point throughout the process. And I don't know the pricing of those off the top of my head, but I'm pretty sure it's like $30 for a gold. And then if they hang up, it's anywhere between $5 and $10 for the silver. 1, 2, and 3 month mortgage. Those can be anywhere between, $3, $4, $5, $9, and age mortgage protection, $2.50. So fantastic leads. All of them can get you an opportunity to increase the premium per person that you sit with. So we won't dig too deep into the lead types. I just want you guys to know what is available. I do want to dig into just some different scripts. So we've got the new mortgage mailer, the call-in mortgage, 1, 2, 3 month mortgage protection, and the age mortgage protection. I think it's important to know that all phone scripts, no matter what the lead type, are exactly the same. They're exactly the same. The only difference is the intro. So don't freak yourself out thinking, oh, well, I've been calling instance, I've been calling final expense. What do I even do when I call a mortgage lead? For some reason, people think that like if someone holds a mortgage, that they are like more, more educated or more financially sound than we are. We get intimidated by somebody who holds a mortgage, but I mean, anybody who has a good paying job and decent credit, they'll give a mortgage. You have an insurance license, so you don't need to get intimidated by anybody who holds a mortgage and these mortgage protection leads. The phone script is the exact same, no matter what the lead type. The only difference is the intro. And I'm going to give you guys a couple of different intros. So with the Insta Internet script, it's simple. Mike, this is Jamie calling you in regards to that inquiry you sent into my office about the life insurance for Lynn County. I'm just the medical underwriter who's been assigned to get that informational packet out to you. I just need to confirm a delivery address. I got you at the 123 Main Street. Is that correct? Correct. Okay. New mortgage mailer. Mike, this is Jamie getting back to you in regards to that postcard you filled out, looking for something to pay off your house when you pass away. I'm just the medical underwriter for Lynn County. I've been assigned to get you that informational packet. I just need to confirm the delivery address. I got a 123 Main Street. Is that correct? Simple. So I'm calling in regards to that postcard you filled out. It's important to bring that back to the top of their mind. Okay, because they remember that they got a bunch of these things in the mail. You'll hear from people, yeah, I got like 20 of them in the mail and I finally decided to send one back in. Okay, so I'm calling in regards to the postcard. I'm looking for something to pay off the house when you pass away. When it comes to a typical instant lead, I'm calling in regards to the inquiry you sent in about the life insurance, because they were looking for life insurance versus this is about the one to pay off your house when you pass away, to bring that back to the top of their mind. Very simple, new mortgage mailer intro. And then after that, you go into a typical normal script. Call-in lead, very similar, a tad bit different, because I say on the new mortgage lead about the postcard that you filled out and sent back into my office. A call-in lead, they didn't send anything back into my office. All they did was call the phone number. So, Mike, this is Jamie. I'm the local medical underwriter for Lynn County. I'm getting back to you about the postcard you received in the mail regarding your mortgage. You called in a phone number and you verified your contact information. I'm showing your address is 123 Main Street. Your loan amount 100,000 through Quicken Loans. Is that correct? Perfect. Like I said, my name's Jamie. I'm just the underwriter assigned to do your eligibility and figure out what you qualify for. Simple. Difference there is I'm calling in regards to the postcard you received and you called the phone number to verify your information. It's all about bringing the process back to the top of their mind. That's what brings credibility. 1, 2, 3 month mortgage lead. Okay. This is one where you're going to get a lot of people who they don't remember it or they already got it taken care of. Okay. Or people who just never got called. Believe it or not, you would not believe how many of these leads have just never, ever been called by anybody. And it's a brand new mortgage lead that normally would cost $50 for $9. So Mike, this is Jamie, medical underwriter here in Lynn County. You probably won't remember this. I'd be surprised if you did. But back when you financed your mortgage, you filled out a request, signed it, and sent it back into my office. Looks like you wanted info on that plan that would pay off your mortgage in the event of a death or make payments if you became disabled. We recently did an audit and realized that you never received the information you requested. So I'm actually a manager here. I've been reassigned to your case to get that information out to you. I just need to verify the information you put down to make sure it's still correct. I've got an address here of 123 Main Street. Is that still correct? Yes. Okay. So you can shorten that. That's a little wordy. And I'm calling in regards to that postcard. You might not remember it. Back when you financed your house, you sent it in looking for something to pay off your house. I'm a manager here. We realized you never got the request. My job is just to get that packet out to you. I got the address here, 123 Main Street. Yes. Okay. And we're not going to dig too deep into overcoming objections here on this call, but very simple intro. And then you got the age mortgage protection lead, the ones that could be anywhere between 1 and 8 years old. This one, Easton Padden script right here. He's a master at these. Mike, this is Jamie at the Mortgage Protection Office calling you back about that mortgage protection form you had filled out and mailed in a while back. This was just to pay off the 123 Main Street house if you get sick. I've got 8/15/1970 listed as your date of birth. I wanted to make sure that's correct. Really important. What is this again? Repeat the first part again to clarify why you're calling if you need to. They say, okay, perfect. We just did an internal audit and we have you guys flagged here as incomplete or due for review. I'm actually the head underwriter for the county assigned to get this out to you. To you guys, they have me dispatched in an area tomorrow, seeing about 15 families. Are you still working a little bit part-time or full-time? Okay. And you move right back into the normal script. So very, very simple scripts. It's all in the intro. Okay. So now we book the appointment, we get to the house, we go and we sit down with the family. We set the table. Okay. When we set the table, setting the table is as simple as, why'd you fill this out? Okay. What was going through your mind when you sent this request into my office? What's nice is that when I go and I sit down with somebody for mortgage protection, I can slide that lead card in front of them that has their handwriting on it. And I can say, hey, Josh, is that your handwriting? Yeah, that's my handwriting. Okay. Or I say, hey, which one of you guys filled it out? If I'm sitting here with the husband and the wife and they go, oh yeah, that's my wife's handwriting. She's got way better handwriting. That happens all the time. So at that point, I go, can you guys just verify for me that information is correct right there? That looks correct. That's your handwriting. You did indeed fill that out. Somebody else didn't fill it out on your behalf. No, we filled it out. Okay. Well, Josh, Michelle, can you guys tell me a little bit more about what was going through your mind when you filled that out? And it's the exact same as any other appointment. Well, we just wanted to make sure if we passed away, everything was taken care of. Well, what was taken care of? The house was paid off. Okay. And we dig into that. It's like, well, what would happen if you passed away and you didn't have this type of coverage in place? And we open up the door to why they need it, because it's important that in every single sale, you don't just have the logical reason, but you also have the emotional reason. Okay. And we'll dig into that here in a second on how we paint the picture. And I think it's important to learn how to paint the picture. We use the financial inventory. Okay. So the financial inventory, you guys have seen it. A lot of people, they skip over this top section. This is one of the most important sections. If you're sitting with someone who's not a renter, but they live in a house, if you skip over this section, you will miss out on mortgage protection opportunities when you're in a normal life insurance appointment. Just by finding out what do they owe the bank? What's their home worth? The equity. Okay. What is equity? Equity is how much of their house they actually own. So if I'm sitting down with Mike and Kate and they say, well, we owe $230,000 on the house. Well, hey, Mike, ballpark me. How much is the home worth when you last got it appraised? Oh, it was probably worth about 430. Okay, so you guys got about 200,000 in equity. All right, 230 in the top, 430 in the house value, and 200K in the equity. Oh, so you guys got a fair amount of equity. Good work. Okay, and when you guys finance the home, was not a 15, 20, or a 30-year term. Okay, all that means for someone who's not familiar with mortgages, are you going to pay off your house in 15, 20, or 30 years with the bank? 30. Most people do that. Okay, and ballpark me, what's your monthly payment? Taxes and insurance included. Our monthly payment, it's about $1,450. Got it. Okay, and are y'all planning on paying anything extra towards the mortgage to try to pay it off early? We'll probably throw an extra couple $100 a month on there. That's a big one. If someone says yes to that, we'll throw an extra couple $100 a month. Pause, slow down. Perfect. That's really smart. That's what most people do. Now, what we see a lot of our clients do is rather than trying to find extra money out of their budget, they just reallocate some of the money that they were going to put extra on top of their mortgage towards a plan like this. You guys can see why that'd be valuable, right? So you don't have to spend anything extra. Yeah, that makes perfect sense. Great. I found the money. They're putting something extra towards the mortgage. No, we don't plan on paying anything extra towards the mortgage. Got it. If someone says no, I know that I need to dig a little bit deeper into the budget to find the money. Okay. So simple. I go through the financial inventory. I figure out their age, their occupation, their monthly income, their medications. If they've, had any of the specific conditions, then I really spend just a little bit of extra time on the mortgage information. That's it. That's the major difference between a final expense, a life insurance appointment, and a mortgage protection appointment is if you spend a little bit extra time in the financial inventory. We use the financial inventory to gather info, to find the problem, and then we paint a picture of what their financial future would look like for the survivor with or without the insurance. Okay, that's important. So we gather the info, we find the problem, and we paint a picture of what their financial future would look like for the survivor with or without the income. So I'm going to bring you guys back on now. Mike, let's just say we're sitting down with, Bob and Mary, and, Bob makes $4,000 a month and Mary makes $2,000 a month, and their mortgage is about $2,000. How are you going to go about painting the picture for them of kind of what you see based on the financial inventory?
Yeah. So, I'm basically going to sit down and, based on the income, and I'm a very, very visual person. So I'm kind of going to draw that out on the paper, and I want to find out a couple different things as far as like Social Security payments, income, right? So, obviously if Bob were to pass, is Mary going to lose, right? You can only get the more higher Social Security, right? So you're going to lose something. So you want to find the income difference there. And that's where you want to kind of target the bigger premium or bigger policy, right? So when I break down, Bob's got 4, Mary's got 2, and you lay out the mortgage, really I'm circling the equity. And that's the goal. And I want to point that out, that to them, like I call it free life insurance, right? Because if something were to happen and they have that equity, they can sell the house. Now, here's what we want to do in a couple different scenarios. I'm going to lay out options, and it all depends on, the financial inventory based on their health and their budget and what it's looking like. But I'm either going to present to them equity protection, or I'm going to present to them mortgage protection. But before I go into which one and explaining the benefits and selling a CBO product or an HMS product, you don't want to get ahead of yourself and sell a product that they can't qualify for. And I used to do that all the time, right? So you want to lay out and see based on their health what you think that they would qualify for. And then based on the difference and what they're trying to do, that's how you want to present it. So I don't know how deep you want me to get here.
Yeah, no, that makes sense. So I have a question for you. So do you kill one of them on paper? And if you do, can you explain what that means?
It depends on how deep they're thinking about it.
Okay.
Right. So like if they start to give me some objections, and I usually talk to the wife, because typically, like it's typically the wife that's more emotional, right? And she wants to make sure that she has the security. Whereas most guys, we're like, we'll figure it out, right? we'll go out and get 3 jobs, whatever, right? But like, no good husband wants to leave their wife behind to struggle, right? And I make a joke with them. I'm always like, like if my wife wants to get remarried, it's going to be for love. It ain't going to be for money. So, and it gets them laughing, right? But like sometimes it depends on how deep that I have to get. But I will say, now, Mary, I understand that, that Bob doesn't think this is super important right now. But realistically, if Bob didn't come home yesterday and you have, a $400,000 mortgage with 200 grand in equity, and you need to make the payment, like we can't afford, would you agree? We can't afford to lose that equity, right? Because even if it gives you time to sell it, then we have that money that you can survive on for a little bit. So we don't necessarily need to pay off the whole thing. We'll lay out options to do that if you qualify. Does that kind of make sense?
Yeah, no, that makes perfect sense, man. I've had a couple of experiences where, the wife is super into it and the husband's not as into it. And the husband I go, okay, so Mary, so if something were to happen to Bob yesterday, what would you be doing today? And Bob starts to answer for Mary. And, this kind of, I had to get a little bit bold and I had to get a little bit out of my comfort zone to say things like this, but you do it in a respectful way. And I go, Bob, hold on for a second. I'm talking to Mary right now because in this scenario, you're dead. And it's like, it's super intense actually. And like, it's kind of funny when we say it on here, but it's like, listen, I need to hear what Mary would do. I understand that you have advice for her, but she doesn't have your advice in this scenario. She doesn't have your guidance, or vice versa. If the wife's the breadwinner, either way, whoever is the breadwinner, I'm talking to the person who would be in a worse financial position if the other person passed away. And if the other person tries to talk over them and say they'll be fine, they could just do this, this, and this. I say, respectfully, in this scenario, you're dead. I need to hear what they have to say. It's that serious. And it brings a whole different vibe to the rest of the appointment, because they're just like, whoa, what just happened there? And it's like, when I talk about killing them on paper, and Mike talked about breaking down the income. So if Bob makes $4,000 a month and Mary makes $2,000 a month, okay, Bob, break that down for me. So part of that Social Security, yeah, about 1,200 Social Security, got it. Okay, and what's that other 2,800? That's my VA disability. Got it. Okay, and Mary, that 2,000, yeah, 1,000 of it's Social Security and 1,000 of it's a pension. Okay, got it. Okay, so based on this, if Bob were to pass away, I cross out Mary's income, the 1,000 Social Security, we're going to lose the 1,000, we're going to keep the 1,200. I circle that. Okay, and Bob, how much of your disability does Mary get to keep? 50%. Got it. Okay, cross out that, right? 1,400. So now I got 1,200 plus 1,400 plus her new 1,000. Okay, so 1,200 plus 1,400 is 26 plus 1,000, 3,600. So we just went from 6,000 a month down to 3,600 a month, and your mortgage is 2,000. You guys have a car payment, an RV payment. You've got credit cards, phone bill, groceries. We just broke all this stuff down. So that would leave you a couple $100 a month. So yeah, you probably would be able to make it, but Mary, could we agree that that's going to be a lot tighter than it was right now? In other scenarios, you break it down and you see that Mary makes $700 a month. And when Bob passes away, her new income is $1,200 and the mortgage is $2,000. And that happens all the time too, which that just makes the reason for the mortgage protection that much more important. So, Josh, let's bring you on real quick. How do you, I guess, talk to the husband and wife, whether it's a husband, wife, or maybe it's even a single person that's wanting to protect the mortgage for their son and daughter? Like, how do you break down the financial inventory and really paint the picture for them of what you see?
Yeah, absolutely. I mean, a lot of what you guys said, I would just go back to the financial inventory that I know I've talked with other agents, and I can be a victim of this as well, where I get a little loose with the inventory. I don't fill it all out. There's that one question on the top right that says, are you paying anything additional on your mortgage? I mean, that I can't tell you, I'm thinking of several bigger sales that I made if I wouldn't have had I not asked that question, right? So there was a gentleman, husband and wife sitting there. The wife doesn't work outside of the home. The husband makes all the money. And he pulls out this big universal life policy that he had from years ago. It's a great policy. It's like $200,000. And, seemingly it covers final expenses. It covers the mortgage. It's going to do pretty much everything. I could have walked out of there, but because I said, hey, are you putting anything extra against the mortgage? And he was putting like $400 or $500 at that time. I was able to say, well, hey, you have a great plan right here, but let me show you something. I did exactly what you're talking about. The wife was there and I said, look, okay, the mortgage is paid off. The final expenses are taken care of, but you make 50 grand a year. You got a bunch of other bills outside of the mortgage. How is your wife going to pay those things? And they're just kind of looking at each other. And, I just let him sit there and kind of work it out. And he's like, well, I don't know. And so, we put an additional policy in place really just for income replacement. Now I was there for the mortgage, right? So basically showed him how he could have more money at the end of the day, cover the mortgage, cover everything. And, the wife could have money as income replacement. So, first and foremost, just answer all the questions on there. Even if you think they don't apply, you just never know when it's going to miss. And the other thing is, you said this, but this is really just a personality thing. I know that maybe a lot of us have to overcome. I like to be liked. I don't like to ruffle feathers. I'm more of a passive guy than an aggressive guy. But we call it challenging the customers, challenging the clients. Like if we don't have these conversations, these uncomfortable conversations, they might never have them. And then you get a call from a client that says, oh, I thought I had enough insurance, or I didn't have any insurance, or maybe it happens to somebody in your family or whatever. And you're like, man, I wish I would have asked the hard question. So whether it's like what you're talking about, or I was talking with a husband and wife recently. And like you said, the wife was like, hey, this is important to me. I need to be taken care of. He makes all the money. So she's telling me all the reasons why, and he's just arms folded. I can tell he's super analytical, and he's just not buying it. And all I asked him was, hey, sir, what she said, how does that make you feel? And he all of a sudden he got really uncomfortable because now he's on trial and he's got to justify to her why he's either going to go with it or not. And of course they did go with it. It was the right thing to do. And so it's just asking those uncomfortable questions. Here's one more for you that I think is overlooked quite a bit. This happened just yesterday, where again, we're there for the mortgage, but there's all these other things. So a lot of times we get so focused on maybe it's, the man that's the breadwinner. All right. Maybe that's the situation. So we're focused on, hey, if something happens to him, the mortgage is taken care of because the other spouse can't take care of it. But the truth of the matter is, I know in our household, right, if something happened to me, or rather something happened to Michelle, right, she runs all the back end of the business. She takes care of the kids. Like, I need a full-time recruiter, I need a full-time nanny, and I need somebody just to help keep me sane. Like, where is that going to come from too? Right. So it's just like Mike said, getting it all down on paper, getting important things. And maybe you can't take care of all of it, but certainly that's going to give you more reasons, more of a why to actually go ahead and put something in place.
100%. When you're sitting down with the husband and wife, the reason why you would focus more on the breadwinner is when it comes to a budget situation. So if it comes to a budget situation and they're like, we only have $100, I'm putting all my focus on whoever the breadwinner is, and I'm maxing out that $100 for as much coverage as we can give them for $100. And I'm squeezing as much as I can. Let's just say it's the wife who's the breadwinner. We're going to put as much coverage on the wife as possible, because I say things like this. I'll go, Bob, Mary, I think we can agree that if either of you guys pass away, you guys are each other's best friend, and it's going to be emotionally devastating for either of you. But I think we could agree that if Mary passes away, not only is it going to be emotionally devastating for Bob, but it's going to be financially devastating. Can you guys agree with that? They go, yeah, we agree with that. So what we're doing is we're building up the financial inventory and we're showing them what we found. So I am filling out the financial inventory and I'm looking at it and I'm finding the problem. So it's like, I imagine that when I have a blank financial inventory, it's my blank canvas. And when I'm going through and I'm asking the questions, I'm Picasso and I'm painting a masterpiece. And now my job is to describe to them what I see, their financial future, if one of them passes away. That's my job, is to describe what I just painted. Okay. It's important to understand that. So when you finish describing to them what you see and you do some of those things like challenging them, this is the perfect time to insert what's called a trial close. Okay. So a trial close is when you say something like, and you could see why that will be valuable, right? And it gives them an option to say yes. The more times that we trial close and get them to say yes, the more likely they are to say yes at the end of the appointment. So when I was going back on that scenario with Mike, okay, so I see here that the new income is going to be about $3,600 a month. The old income was $6,000. So it's going to be obviously pretty tight for Mary to keep making that mortgage payment. So you guys could see why something like this paying off, and this is before I've shown any numbers. I'm just conceptualizing at this point. And you guys could see why having the mortgage paid off and not having that $2,000 a month payment, you could see why that would be valuable, right? Yeah, I see exactly why that'd be valuable. Okay, so you challenge them, you break down what that is going to look like, and then you prescribe the solution. Okay, problem, desire, solution, close. If you guys write down anything, write that down. Problem, desire, solution, close. We use that in all of our marketing videos when it comes to recruiting, and we use that when we're in the home. We break down the problem, we build up the desire, we offer a solution, and then we close. And that's what we're going to get into here in 1 second. That's how we're going to end the call, is with the different types of closes and just building up the value. So we paint the picture, and then we offer a conceptual solution. Okay. And when you're offering that solution, this is not showing numbers yet. Okay. Because we still have to figure out what they're eligible for. So if it's somebody who is in a certain age bracket, we're going to do what's called equity protection, which we're going to explain to you guys what that is in a second. Another age bracket, we're going to show them cashback option if they're healthy. A different age bracket, Josh, he's going to talk about index universal life, which is something a lot of you guys might not even know what it is, but different ways that you can help different clients protect their mortgage, because it comes down to a couple of different things. It comes down to their age. It comes down to their health. It comes down to their budget. Okay. Age, health, budget. If you're over 60, you can't qualify for cash back. If you're over 85, you have Aetna, 85 to 89. That's it. If you're over 80, there's only a couple carriers that you can qualify for, 2 or 3 different carriers, Americo, AMM, Aetna. Okay. Everything else is just 50 to 80. If they're, looking at something where they can't afford, they're in their 50s and term's going to be too expensive, we're going to show them whole life. My typical rule of thumb that Grady taught me when I first started was, if they're 18 to 50, show them whole life. And if they're 50 to 85, if they're 18 to 50, show them term. And if they're 50 to 85, show them whole life. Now we're going to talk in a second about right in the middle, this perfect demographic for an IUL, but typically, depending on the situation, you're going to show different clients, different benefits. So let me just break down here our couple of different closes, and then we'll end this thing out. So we've got a traditional term. We've got a term with cash back. We've got accidental, equity protection, and we got indexed universal life. Now there's so many different angles you can take at this. We're not going to look at every single angle. Term, 10, 15, 20, 25 years. The mortgage is $250,000. Okay, here's a $250,000 term through Americo Mutual of Omaha, John Hancock. You're 38 years old, you're 52 years old. Here's what it is. Now, term, it's going to last for a certain period of time. So that means at the end of that period of time, it's going to expire. Term plus CBO, same exact thing. It's going to expire, but at the end, they get all their money back. So one of the ways that I'm able to pitch term plus cash back is I go, okay, Mike, traditional life insurance, the way that it works is that if you pass away, the home is paid off, obviously. But what happens if you outlive the policy? You just paid your $83 a month into this policy for 30 years, and the insurance company gets to keep all of your money. That kind of sucks, right? Yeah, that does. Okay. Well, imagine if at the end of that 30 years, you were able to get all of your money back at the end. Like, that's crazy. I've never heard of anything like that. Well, that's the cashback option. A couple of different policies do that. You can get all your money back at the end. And if you got all your money back at the end, how much money did you spend on it? Well, 0. Okay, perfect. So term plus cashback, accidental is either a great add-on or downsell. Okay. So if you have someone with a big mortgage, let's say it's $750,000, you can show them 250,000 term plus cash back, plus another 500K accidental. If they pass away in an accident, the whole 750 is paid off. You got husband and wife, write them up both CBOs, throw on a spousal accidental. You got equity protection, which very simply is rather than paying off the whole home, like I said in the definition here back in the beginning, we're going to leave behind a few years worth of mortgage payments for the surviving family member. Okay. And I'll have these guys break down kind of how they go about it. Then index universal life, which is kind of the best of both worlds of term and whole life, permanent product. And I'll let Josh kind of explain, what he does with that. So, I kind of gave you guys a breakdown of, term and term plus cash back. I'll come back to that and show you guys my favorite close that I like to do, which is husband, wife, term cash back plus accidental cash back. I'll explain that one at the end. But Mike, let's have you jump on here. And, when you get a mortgage protection lead, somebody that is, let's say, in 60s, 70s, 80s, and term is just out of the question when it comes to price. How are you explaining what equity protection is? How are you pivoting to equity protection when maybe they're expecting, well, I want to pay off the whole house? How are you explaining to them the value of equity protection?
Yeah, well, first things first is if that's what they want and their health provides it, I'm showing it. So I don't just go to equity protection. I'll show max coverage all day long. But if it's an equity protection close, I mean, it's pretty simple. So I'm going back to the equity, right? And I'm laying out that we can't afford to lose it because you've worked hard, you've built up this equity in this house, right? So we can lay out a couple options. It all depends on the coverage amount, right? So, I mean, you could even lay this down as somebody with AIG, right? $2,000 a month for the mortgage, active cancer or had active cancer, whatever situation for AIG. And that, $2,000 a month, that's 24 for 2 years, right? You can lay out AIG equity protection for 25 grand, right? Now, obviously we know we have the 2-year wait, but you lay out the fact that, Bob, if something were to happen to you, then the main goal is that we don't lose the equity, right? So the coverage isn't applied to the mortgage directly. This is applied to your wife, and it's a tax-free death benefit. So she's going to be able to utilize that money to make the mortgage payment. Now, if you're just like all the other clients I set with, you think your house is perfect and it's going to sell day one, and it probably will because this is a really nice house. But at the end of the day, we can't guarantee that. So what we want to do is make sure that Mary has, and it depends on their budget, right? You could show 6 months, 12 months, 18, whatever. But we want to make sure Mary has enough funds, tax-free, that, is going to get around any type of probate or anything so that she can make the mortgage payment comfortably. Because at the end of the day, the bank don't need the whole house paid. They need the mortgage payment the next month, right? So would you, again, it's trial close, would you agree that protecting the equity on this house that you guys have spent 20 years paying for is very important? Right. Okay. So here's how we're going to do that. And then you lay out the numbers. Okay. I've got, and again, it goes back to the budget. Everybody's different, but I show max coverage. So I'm showing, 18 and 24 months, right? Let's go ahead and give Mary almost, 18 to 24 months of financial security. She can make the mortgage, pay anything else she wants to. And then we're going to submit a request for coverage. So that's just kind of how I go into equity.
How do you, Mike, just for anybody who maybe isn't tracking, how do you figure out what 18 or 24 months of coverage is? Like, how do you come up with the face amount?
Yeah. So I'll take the monthly premium, right? And then multiply that. So if it's $1,000, 1,000 times 12, right? 12 grand.
You mean the mortgage payment?
Yeah. So 12 grand would be a year's worth of mortgage payments, right? So 2 grand, 2 years, right? And that's how that I come up with that number. So I actually don't show them. So when I show equity protection, I don't show them 12 grand, 18 grand, or 24 grand. I show them 1 year, I suck at math. Anyway, 1 year or 2 years, right? Like I'm showing them the amount of years, right? So for 2 years of mortgage payments, Bob, it's $349 a month, right? That's how I write it down. I don't even tell them the dollar amount, because then they're going to, oh, well, you know, I should maybe save that. Like, no, we're not saving nothing, because if you had money to save, you would already saved it.
That makes a lot of sense. So you're saying rather than writing down 24,000 equals 349 a month, and then underneath it, that's 24 months of mortgage payments. You're just like 2 years of mortgage payments equals 340. I mean, that's dope, because I can't tell you how many times I've sat down with somebody who they're looking at just the dollar amount. They're like $24,000 worth of life insurance. I saw a commercial where I could get, 250,000 for $995 a month of life insurance, this mortgage protection, and so that makes a lot of sense that you do that. I'll write down, I like to give them a couple of options. I'll give them, let's say 6, 12, 18 months, depending on their budget. And I'll ask the question, rather than, hey, 24,000 equals 240, 18,000 equals 180, 12,000 equals 120, which one of those makes the most sense? I look at whoever is the most vulnerable spouse, and I say, so Mary, how much time would you prefer when Bob passes away? You want a year and a half, or 2 years to sell the house? I don't say, do you want $24,000 in coverage? I say, how much time do you want? I want 2 years. Okay, perfect. So, and also I think it's important that when you're breaking down equity protection, you explain and you use words like critical time period. It's like, okay, well, Bob, Mary, we want to make sure that, God forbid, if something happens to you, that Mary is covered during a critical time period. We want to make sure that she has time to, number one, mourn. I always talk about this. I bring it back to the emotion again. I say, hey, she needs time to mourn. I don't know where the statistic comes from, but they say that the typical person needs at least 6 months to mourn before they make financial decisions. Wouldn't you guys agree? Oh yeah, that makes perfect sense, because the one thing we want to avoid is Mary making irrational financial decisions because she's mourning, because some vulture real estate agent decided to come knock on the door, and we said your house is worth 430 and you have 230 that you owe. So you have 200K in equity, and they offer her 330. And she's desperate, and she loses 100K in equity that, Bob, you worked really hard for. Does it make sense why we want to make sure that she has at least 6 months? Yeah, perfect. Awesome. You got 6 months for mourning. Okay. So we also want to make sure that she has time to get the place cleaned up, cleaned out, listed, and sold. Can we agree that she's probably not cleaning out the house when she's mourning? Yeah, we can agree with that. Okay. So we need at least another 6 months to get it cleaned up, cleaned out, listed, and sold. And now we need at least another 6 months to a year in case, God forbid, another situation like 2008 happens where the market crashes. We need time to be able to make sure that they can sell the house for the maximum value so they can get the maximum equity out, because, Bob, we can agree that right now the housing market's pretty inflated, right? So if the housing market crashed tomorrow, I know that it says that your house is worth 430 on Zillow, but if the housing market crashes tomorrow, it's probably worth 330. So you lost 100K overnight if the market crashes. So wouldn't you agree having like a year to sit on the house while she's making that mortgage payment would make a lot of sense? You see how that'd be valuable, right? Yeah, I see how that'd be valuable. Perfect. So 6 months to mourn, 6 months to get it cleaned up, cleaned out, listed, and sold, and at least a year to sit on the house if you need to. So about 2 years, max, probably anywhere between 12 months and 2 years. You guys can see why that'd be valuable, right? Yeah, we see why that'd be valuable. Time to be able to decide what you're going to do, because the bank's not your friend. Time for her to decide, am I going to sell the house? Am I going to move in my son and grandkids to help make the mortgage payment, find a roommate? Am I going to rent the house on Airbnb and go, get a smaller house? Am I going to put some money down to refi it? It's all about time. How much time do you want to figure it out? Because you're going to be mourning. So you want 6 months, 12 months, or 18 months? I want 18 months. Perfect. Let's go ahead and submit a request for coverage and see what you're eligible for. Boom. We move on to the next step. So I appreciate you so much, Mike. Thank you so much for jumping on here. Josh, let's talk IUL. So then I'll dig into the traditional options, the most popular option, and we'll get off of here. So can you explain to everybody what an IUL is, and specifically what the IULE is with Mutual of Omaha?
Yeah, absolutely. I'll keep it, pretty simple, pretty surface level, because again, I think it's one of those things that initially is very scary. In index universal life, it's this whole other thing. And it really is quite simple. So basically, just think of it as a between whole life and term, right? So when you're paying money into a universal life, Part of the money is going towards the death benefit. Part of the money is going towards cash value. It's really all it is. It's not a true whole life, so it's going to be cheaper than a whole life, dollar for dollar. And it can be permanent insurance, so it's not quite term. And really, in a nutshell, that's all it is. And so when I'm talking about it, I'm saying things like, hey, there's a permanent option, and I'll go into like the ideal client that it's a layup when you meet this client. Hey, we have a permanent option. The great about it is it's a very flexible option. All right. The premiums can be flexible, meaning you'll get targeted on a premium. You can overpay if you want it to grow a little faster. And God forbid, you could underpay, although you don't really want to do that. I'm just letting you know that option. And people they like options. They like flexibility, especially if you're talking to somebody who's self-employed, because sometimes you're up, sometimes you're down. So that's just a nice additive. But with Mutual of Omaha, they have the IULE, Index Universal Life Express. It's a simplified underwriting option. So there's no blood, urine, all that. So it's just like everything else. And I tell you what, for the right client, it's an awesome product. And so when you're talking to, your older clients, I'm going to say somewhere between that 60 to 70 crowd, 62 to 70, especially if they're non-smokers, you're sitting down and you're talking about covering, 100,000 or 150,000 or whatever, whether it's term or it's a cash back option. The prices get pretty ridiculous in that range, right? So if we're talking to somebody who's 65, obviously cash back option is no longer on the table. It's only a term, and depending on which carrier and their health and smoker, not smoker, maybe they can only get a 15-year term or a 10-year term. And then you start throwing out numbers that are in the hundreds of dollars. Still there's a lot of clients out there that they want the protection. They want to cover the house, but it doesn't make a lot of sense to have a 10 or 15-year term for a lot of people. And so I can tell you, I've written up a few 70-year-olds. Now the IULE goes to 70 years old. And so what I can tell you, the max coverage for a 70-year-old is $150,000. And I just happen to know the premium is $623 a month because I've written several of them recently. And how it works, especially if they're non-smokers, is if you go run any term option for the same dollar amount, 150,000, the IUL is going to be the same price or even cheaper. And people will say, well, why is that? I don't exactly know, but it is, right? I could show you the numbers. And so I have these conversations where somebody said, hey, I want to leave this money behind. I want to cover the mortgage. And you start saying, well, it's a 25-year mortgage or a 30-year mortgage. It's a 20-year mortgage. And you can only offer maybe a 15-year, or it's a 30-year mortgage. You can only offer a 20-year. That's just not a great option. You say, hey, listen, it's as easy as this. Hey, Jamie, we're looking at this, but have you ever heard of an IU, Index Universal Life? A lot of times older clients have, this product's been around since the 80s, 90s. A lot of times they have. And they go, yeah, I've heard of that. We'll say, hey, listen, for about the same price or even cheaper, and I'm kind of running my numbers before I'm presenting them so I can kind of confirm this, we can get you on a permanent product. All that means is it can last long term, and it builds cash value. So for the same dollar or even less dollars, you're building equity in your policy. How's that sound? They're like, yeah, that sounds great. So of course, with these, I'm going to give you some, somewhere to go so you can, really see the numbers. But honestly, I've sold a few dozen of these since I've been here on really just that conversation alone right there. There's nothing more that needs to be said. You run the quote on Mutual of Omaha, the online quote tool. You show them the numbers, you close it down, and you put an application. Now, a couple things on this as far as underwriting. I know sometimes I've heard, IULs can be really, really tricky to get approved. As a rule of thumb, I mean, if you have the cheat sheets, just go by the Mutual of Omaha, term underwriting guideline. Or if you're like me, Mike, or Jamie, almost every person, you're going through the first couple pages of like an Americo Term 100 or CBO 100. And so if they're not going to qualify for an Americo product, chances are they're probably not going to qualify for the mutual. Not always, but probably not. Right. So if they're on insulin, if they got COPD, neuropathy, they're not going to qualify. Right. If they've got diabetes and they're taking, metformin, that's okay. But just, the harder stuff, they're not going to qualify. It is pretty picky. Okay. And the other thing is, so what you want to do now, you don't need this to start selling. I'm telling you, I've sold several dozen on what I just told you, right? The ideal client, like 61, 62, non-smoker to 70 years old. It's going to be the same price or even cheaper as a term product. It's a layup. It's like because you show them the price for the term, it's $500 a month, it's $300 a month, or whatever it is. And then you say, hey, for the same dollar, we can get you a permanent product, cash value, all the rest. They're like, yeah, sold. I'll take it. But go on to Mutual of Omaha. Under sales tools, there's something called WinFlex. And all that is a online software that you can run illustrations and see how the numbers, and this is how I learned, about IULs. I was on some calls and then I just went in there, I ran them and I just started reading them. I'm like, well, what does that mean? I'd go in the illustration, I'd read the definition. That's how I learned it. Right. So once you register for WinFlex, it takes 24 hours. Then you come back, you log in and you say, I want to run illustrations for a Mutual of Omaha. And then you can go in there and that's how you really, can run detailed quotes, see what the cash value is going to do. Because some of these clients, especially on the upper end, if we're talking about a few $100s of premium per month, they're a bit more savvy. Obviously, they have some money, and a lot of them will look at the cash value, and you can do some things on this. But I had one of the first ones I sold. I didn't present it this way. I went on WinFlex. I downloaded the illustration. I showed the guy, I let him look over and he goes, well, wait a minute. I'm paying $600 a month for this, but it looks like, after 5 years, I have half the cash value is what I paid. So in a sense, this only cost me half of the premium. So, well, yeah, that's a great way to look at it. He's like, okay, I'll take it. So had I not had that, I might not have made that sale. Now you don't have to have it to do this. But of course, it's just an extra tool. So that's how you will run the illustrations. You can download them, print them off, send them, whatever you want to do. And let's see, there was one more thing I was going to say about that.
That's a good place. Let's pause right there. I think it's important to also note that, myself, Josh, Mike, we've sat with so many people where we didn't know that this was the right product for them. And instead we just jammed a term 100 down their throat. And there's nothing wrong with that. However, the most chargebacks that I've personally gotten in my business when it comes to big policies have been somebody that I should have presented an IUL that instead I just gave them a term 100. So let's say the premium was $750 a month for a 63-year-old who wanted, $250,000. I use my skills and I show the value and I sell it, but then buyer's remorse kicks in because that person realized really quickly that it's only a 15-year term. And if they make it to 16 years, that the insurance company gets to keep all of their money. And if I would have had the education to know that I could have put them in a permanent product that was something with cash value, something that also has living benefits. So I want to make sure we touch on that. The IUL has critical, chronic, terminal illness riders, just like the Americo CBO product, just like the Americo term product. So it's got living benefits, cash value. You can borrow against it like a whole life. And it also tracks with the S&P 500. So it grows like an investment. So we won't dig too deep into that, but just know that just like a fixed indexed annuity where the product can go up in price, when the market goes down in value, we get to keep our principal, okay, which is important for people who want safe money retirement. So I appreciate you, Josh. Thank you so much for coming on here. You've been an absolute just Lots of knowledge. Thank you so much, man. So last thing we're going to do is we're going to dig into, and then we'll jump off of here, just a traditional mortgage protection close for somebody who is healthy and in just a 20 to let's say 45 age range. You can sell this product all the way up to 60, but this is probably our bread and butter with Family First Life is the Americo cashback option and the Mutual of Omaha Guaranteed Advantage accidental with cashback. Okay, so let's say I'm sitting with Bob and Mary, and Bob and Mary are in their 30s. We'll just say they're both 33 years old. Okay, so 33 years old, they owe, we're just going to give you guys the perfect scenario here. They owe $250,000 on their mortgage. Bob makes $4,000 a month. Mary makes $4,000 a month. Okay, either of them pass away, the home, or they're going to lose half their income because they're both still working. Okay, so I show, hey, Bob, $250,000 with Americo for 30 years. At age 33, it's going to be $184 a month. And, Mary at age 33, 250,000 is going to be $134 a month. And the reason why there's a difference there is because even if they're the exact same age and the exact same health, males will always be more expensive than females, because males have a lower life expectancy than females. So I write down on the paper, 250,000, 184 a month. I take out my calculator and I do 184 times 12 times 30, and I get 66,240. So, okay, Bob, so if you pass away, $250,000 is going to go to Mary. If you become sick or disabled, you have the ability to withdraw up to $250,000 out of the policy. And if nothing happens to you at the end of 30 years, you guys are going to get $66,240 in tax-free savings that are going to come back to you in a cashback option. Okay, so if you guys get all the premiums back that you paid into it, how much did it cost you? Nothing. I say things like this in these type of appointments. I say, so wouldn't, I say, this is the exact same policy that my wife and I have. If you guys are young, you should have a policy like this. If you don't have a policy, it's kind of hard to sell a policy. It's much easier to sell this policy if you have it. I go, this is the exact same policy that my wife and I have. And I say things like, for most of our life, my wife and I, we've been really, really good at paying our bills, but we haven't been that great at saving. And I say things like that, and couples are like, yup, they're nodding their heads. That's us. We're really good at paying our bills. We're not that great at saving. I go, okay, so for $184 a month, you can have $250,000 worth of insurance and save $66,000 over the next 30 years. So I go, if you guys are anything like me, anytime that I get $2, $3, $4 in a savings account, I find a way to spend it. This is a savings account that you can't touch, that has life insurance and living benefits attached to it. And they're always nodding their head like that makes perfect. And you guys can see why that'd be valuable, right? Yeah, we see why that'd be valuable. So then I show, all right, $184 a month for Bob, $134 a month for Mary, $250,000. We're assuming the budget is perfect. Then I add on $500K of spousal accidental. Anytime that I have a husband, wife who are under 70 years old, I'm showing spousal accidental. The Mutual of Omaha Guaranteed Advantage product up to $500K. I'm showing that. And it's like, Bob, if you pass away in an accident, Mary gets $500,000. Mary, you pass away in an accident. Bob, you get $500,000. You both pass away in an accident. Let's say driving to the grocery store together. Your kids get $1 million. And it's $133 a month. You guys can see why that'd be valuable, right? Such a low cost per unit. Yeah, we see why that'd be valuable. So and then I go, what most people would do, and I circle all three, make sure that Bob's covered for the next 30 years. Mary's covered for the next 30 years. And God forbid an accident happens to you guys tomorrow, the maximum death benefit pays out. So now actually 250, 500 pays out. And now, let's say, Bob passes away in an accident, 750 plus the accidental on the CBO, you're looking at 875 is going to pay out if Bob passes away in an accident. And if nothing happens, you guys are going to get cash back of a little over $100,000. Does that make sense? Yeah, that makes sense. Perfect. So that's probably one of my favorite ways to close out a traditional mortgage protection with someone who's young and healthy. The budget makes sense. That's how you walk away with somebody who's 33 years old, and you walk away with $5,000 in premium, is because husband and wife are covered plus accidental. So let's see, 184 a month plus 134 plus another 133. I'm looking at 451 a month. I'm looking at 5,400. I can't tell you guys how many homes that I've sold between $3,000 and $7,000 in insurance and premium, because I added whether it be Americo Eagle, Moo Accidental, or CBO, Moo Accidental, bringing the spousal policy together with the accidental, it just ups the premium. Also, depending on your state, Josh, unfortunately, in Georgia doesn't have access to this, but the cashback option on the Moo Accidental is fantastic. If you're under 50, cashback option's a fantastic product. So if you guys ever deal with somebody who's under 50, who maybe has a DUI or a felony, they cannot get traditional term insurance. I'll show them a 30-year accidental with cash back, and it ends up being, $80-$90 a month cash back. They get back, 30-40 grand in cash back. They're happy. If they pass away in an accident, they get $500K, but if nothing happens, they save their money and they get all their cash back. So lots of different ways that you can do mortgage protection: traditional term plus cash back, accidental, equity protection with whole life, index universal life. A lot of different ways that you can go about doing it. So just know that mortgage protection, even though we gave you guys a lot of information, it's not as scary as you might think it is. Just like any other appointment, if you've mastered final expense, if you've mastered internet leads, just go back to calling in the home when you get into the home for 15 appointments. Do that for 15 appointments and get some feedback. You'll be able to do mortgage protection all day, no problem, and you'll just get better and better and better. And this is how you increase premium. This is how you learn deeper case design. This is how you learn how to find more issues to solve in the home. So when you work multiple different lead types, final expense, internet leads, mortgage protection, you can go into any of those lead types and pull solutions from the others into that. So I came for final expenses, but I found mortgage protection. So let's take care of your final expenses. So each of you guys got $10,000 American Eagle. All right, now let's take care of your mortgage protection. Okay, perfect. We got that. All right, now let's take care of your life insurance. It's just like, we just keep going with it. So I appreciate you guys for staying on with us tonight. So much value in tonight's call. If you guys got some value, drop a 1 in the comments. And I look forward to seeing all of you guys in Arizona at the Launch 2021 convention. If you guys have questions, please reach out. I look forward to having a great rest of the year with everybody. Have a great night, guys.